Hello everyone. Welcome to the section on ECGC, the Export Credit Guarantee Corporation Limited. In this session, we'll be discussing about the role they play in international trade, different kind of policies like the shipment policy and the products they offer to the banks. Welcome to Brilliant Bankers, your channel for IABF specialization exams. So what is ECGC? ECGC Limited, formerly known as the Credit Guarantee Corporation of India Limited, is an Indian government-owned company that provides export credit insurance to Indian exporters and banks. It was established in 1957 and is headquartered in Mumbai. The primary objective of ECGC is to promote and support India's exports by offering insurance cover against the risk of non-payment of export receivables due to various reasons such as commercial or political risk in the buyer's company. So it is the credit guarantee institution that was set up for promotion of exports by the protection the exporters from any financial loss due to buyer's failure to pay any due to the problem of externalization in the country of import by various types of policies to the exporters. What are the objectives of the ECGC? By facilitate globalization by promoting export trade. ECGC aims to promote and encourage India's export trade by providing export credit insurance to Indian exporters and banks. This helps exporters feel more confident about venturing into the international markets, knowing that they have a safety net in place. By managing credit risk, it minimizes the export risk. One of the main goals of ECGC is to mitigate the risk associated with exporting goods and services. It provides insurance covers against various risks, including the commercial and the political risk, which can lead to the non-payment. By providing information and market intelligence, ECGC offers valuable market information and intelligence to the Indian exporters, which includes the insights on various countries, their economic conditions, and the credit worthiness of the potential buyers. Such information helps exporters make informed decisions and entering specific markets by the overseas buyer. And another point is by facilitating the bank finance. In this condition, the ECGC's insurance covers also facilitate the extension of credit by banks to exporters. When banks know that the export receivables are insured, they may be more willing to provide financing to exporters, thereby easing their access to working capital. Another objective is encourage exporters to explore the new markets by providing insurance against risk associated with the international trade. ECGC encourages Indian exporters to explore new and diverse markets. This can lead to the diversification of export destinations, reducing the dependence on a single market only, and to educate the customers by continuous publicity and effective marketing. Education is done by is actively managing its own risk through the reinsurance arrangements with international reinsurers. This helps spread the risk and ensures that ECGC remains financially stable and capable of meeting its own obligations to the policy holding customers. It also supports the government initiatives. ECGC aligns its initiatives to the Government of India. It plays a crucial role in achieving the government's goals related to the export promotion and economic development. Overall, ECGC's objectives are geared towards fostering a conducive environment for Indian exporters to thrive in the global market while mitigating the risk associated with the international trade. So, coming to the next set of points, it also provides insurance covers to the Indian exporters. ECGC offers various types of export credit insurance covers to Indian exporters. These policies provide protection against the risk of non-payment of export receivables due to factors such as commercial or the political risks in the buyer's country. By promoting the MSME or factoring facilities, the MSME, ECC offers specialized insurance products and services tailored to the needs of the small and medium-sized enterprises, recognizing their significance in India's export sector. By credit insurance and the claim settlement. In the event of a loss due to a default of the buyer, the exporter can file a claim with the ECGC for reimbursement of the insured amount. ECGC evaluates the claim and if valid, and this find the claim valid, it provides the necessary compensation also. It also facilitates the bank's credit. ECGC's insurance covers facilitate the extension of credit by banks to exporters. When banks know that the export receivables are insured, they are again more willing to provide financing to exporters, thereby easing their access to the working capital. Banks and financial institutions enable exports to obtain facilities, credit, or otherwise from banks to enable export to obtain facilities. What are the ECGC policies? The different type of policies that are granted by ECGC for international trade are like the standard policy, which is a basic export credit insurance policy that is being provided. It covers both the commercial and political risks associated with the export transaction. Commercial risks also include insolvency or default of the buyer. Political risks include events like war, civil unrest, foreign exchange restriction, and many more. What is a small exporters policy? It is also called SEP in short, small exporters policy. This policy is tailored for small scale exporters with an export turnover of up to a certain threshold. It covers commercial risk and provides benefits like the low premium rates. It is designed to support and encourage small exporters in the international trade activities. Specific shipment policy. This is offered by the ECGC, which is designed for a single specific shipment not exceeding 180 days. Some of the key features of this type of policy are: this provides a coverage for a single shipment. It is a temporary protection. It's suitable for occasional exporters. It is tailor made for specific transactions and has a coverage for both the commercial and the political risk. The exports policy, specially mentioning the specific buyer, that is exporter specific buyer policy. In this case, this policy is designed to provide coverage for transactions with a specific buyer of a specific country. So only one buyer of that particular country. It is suitable when an exporter has a significant portion of his business with a particular buyer or in a particular country. It offers protection against both again commercial and the political risk associated with transactions in that particular country. What is the export turnover policy? It is designed to provide automatic cover for all shipments made by an exporter during a specific period, typically 1 year. So some key features of the export turnover policy are automatic coverage, annual policy, coverage for commercial and political risk, flexible premium structures, benefits of the scale, some streamlined processes in this. It can support export finance. It has the risk management facility, and it's having a total flexibility in the coverage of the whole thing. These are some different kind of policies that are being issued by the ECGC. Now let's go in detail about the products that ECGC is offering for the banks. The ECGC offer a range of products tailored to meet the need of the banks and financial institutions. involved in export financing. These products aim to protect banks from various risks associated with export transactions. So we'll go on an explanation basis. What is a packing credit insurance? The purpose of a packing credit insurance is to provide coverage for advances granted by banks to exporters for purchasing, processing, manufacturing, or packaging goods for the export purpose. And where does this give the coverage? It protects us against the risk of non-repayment of the protection, sorry, non-repayment of the packing credit due to commercial or the political events. So it gives a protection against the risk of non-payment of packing credit due during the period of the commercial or the political events. What is the export protection finance guarantee? The purpose of this one is to offer coverage for loans extended by banks to exporters for financing production of goods meant for the export. So it offers coverage for loans extended to banks to the extended by the banks to the exporters for financing production of goods meant for export. And it covers the production in case of the default by the exporter on the production finance loan. What is post shipment export credit insurance? It covers advances given by banks to exporters after the shipment of goods but before realization of the export proceeds. What is an export finance guarantee? The main purpose of the export finance guarantee is to provide coverage for term loans extended by banks to exporters for setting up or expanding export oriented production units. And it covers against the risk of non payment by the exporter on the term loan. Coming to the point, export performance indemnity, the EPI, it encourages banks to extend finance to small scale industries by covering a portion of the credit risk. And it also provides indemnity for the percentage of loss incurred by the bank on credit facilities extended to eligible small scale exporters. So these products aim to facilitate and promote export financing by providing banks with a safety net against various risks involved in lending to the exporters. By offering these products, ECGC helps to enhance the availability of credit for exporters and support the growth of the export sector. So, what are the to do points or the points to remember when applying for a ECGC insurance? Or what are the things that you should have in mind when you are going for a ECGC policy? The validity of the policy. Ensure that the policy taken by the exporter covers all the shipment. In case of renewal, the proposal form is to be submitted by the exporters well in advance for the continuity of the cover. The maximum liability of the same. Exporters to ensure that the maximum liability under the policy are sufficient to cover the amounts due from all the overseas buyers or banks at any given point of time. The advance in premium or the advance premium. Exporters to ensure that sufficient premium deposit is maintained with the ECGC in advance based on the turnover projection at all times. Under the policies to cover the premium that will become payable for the future shipments that is to be effected. What is an adequate cover? Exporters should ensure that all shipments are adequately covered by the valid credit limit, loss limit, or a single loss limit. It will be better that if you note it down. The credit limit is shown as CL, the loss limits we tell as double L, and the single loss limit is a S double L on each buyer on appropriate terms of payment before effecting the shipment. Exporters should ensure that before making shipments, the respective overseas buyers' names are appearing on the list of buyers on whom ECGC have a past adverse experience. So they should not be in the list of the past adverse list. What is a specific approval of ECGC? Exporters should ensure that the specific approval is obtained in case export proceeds are proposed to be received from restricted cover countries or the destination of the goods are to restricted cover countries. They should also submit the shipment declaration on or before the 15th of every month of all the shipments effected during the previous months in the formats prescribed by the ECGs. Exporters should also ensure filing claims after submission of the overdue declaration, but within 360 days from the due date of the payment, and no extension will be granted in this case. Exporters should not enter into any compromise settlement or offer discounts without the prior approval of the ECC. These are few points, the two points that is to be remembered while having a policy of the ECGC. It's something about the claims. How do you claim on the policy? So some important points to be noted with respect to the claims are exporters who should submit the claim forms within 12 months from the due date of the unpaid bills and ensure that the premium on the bills are up to date. Claims will not be settled to ECGC for more than 4 buyers during the same policy period. Claims will be paid directly to the banks who have handled the export documents. Banks can appropriate the claim amount directly to the post shipment advance account if there is any, and settlement of claim amount by ECGC does not relieve the exporter of the responsibility of realizing the proceeds, and all further recoveries to be shared with the ECGC on a pro rata basis as and when received. So, on a whole, in this chapter, we have gone through the risk of foreign trade and the role, responsibility, and the products and policies of the ECGC. I think the session was very fruitful. If you do have any queries, please do update your doubts in the comment section. We are ready to and we are here to clear your doubts. Please do like, share, and subscribe. Brilliant Bankers. Jai Hind.